This is our video blog for March 2nd, 2011. And like most days, we want to trade the strong currencies versus a weak. Today, the euro was consistently strong, and you can see the daily, weekly, monthly trend were all slightly up at 3 and even more so later in the day. Swiss, extremely strong today. So, and the dollar is one of the weakest of the two on the top. Most of us trade dollar pairs and yen pairs versus the ones on the bottom. Whatever's the strongest and weakest and most trending, where the odds are the highest, are the what we trade. So the dollar really got weak here at 4 o'clock after many hours of a up counter trend up move against the longer term weekly monthly trend that's down. Then it had very little strength right here. It's pretty safe to assume after so many hours up, when the longer term trend's down and you can see the upwards momentum is dying, to anticipate a potential down move. This is oftentimes what it looks like before weakness shows up. So that showed up around 3:30, but you could have anticipated it after 3. And even before 3, the euro was strong. So you got a very high odds euro buy around 3 o'clock. So here's 3 o'clock. And unfortunately, this one had been doing a counter trend trade down, but you can see the weekly, monthly trend are up. And here is yesterday's low. And it's usually risky buying underneath the previous day's low, but once it comes back above the previous week's low and you can see the weekly, monthly trends up, normally we don't normally buy underneath the hourly. We wait for it to go above the hourly. It's a higher odds trade. But when the longer term trends up, you can certainly look to buy the lows down here, this double bottom right here with almost no weakness the second time, not significant weakness here. Anything less than our 20 level, especially half of that or less, is almost no weakness whatsoever. So because the longer term trend was up, this was a pretty decent double bottom to buy with divergence. That's one of our systems. And again, when it came down again without that much weakness, you could have anticipated that trend even earlier. But at 3 o'clock, we know the euro is strong. The dollar is very likely to start to become weak because the longer term trend's down. This little pullback trade right here is excellent. And if you miss that trade, pretty much just went straight up. But if you miss that trade, when it breaks from underneath above the hourly, that's usually a good breakout if it goes sideways there for 30 or 40 minutes. The only downside with that was we have a major resistance area here. So because of that, I would have actually waited for this to get broken. Then we have a fib level up here with tons of other resistance. And as this thing goes up, the market kind of hits the upper containment band. It has a lot of strength, but not off the chart strength. So this resistance up here at our upper containment band, very likely to be the end of the move. And normally when you find a strong trend, you look to buy a pullback. So many of us, after pulling back 20-30 pips, would have got into this trade right here. And you can see it only went up about 5 or 7 pips. More than likely you would have lost on that trade. Pulled back again. You can see the weakness is actually even less than before. And so when it breaks out over this little sideways range right here, it went lower, starting to come back up, you go long. And these are your profit targets, but it shot right through them. So this was your next profit target. If it stalls there, you get out. And if it goes to, you can see the previous month's high. Great place to get out. I actually took some counter trend trades. I scaled into this trade and made a little bit on this trade, and then I got short again up at 89 up here at the next fib level. Anytime you're way above the upper containment band and the market doesn't have off the chart strength and other pairs aren't really exploding up, it's a pretty safe counter trend move. I got about 18 pips on that trade myself. Another currency, like I said, was very strong was the Swiss. Especially at 8 o'clock here. So you're looking to sell the weak dollar against the strong Swiss. Now here's 8 o'clock. The market's kind of going sideways. You got a little pullback up to the hourly and previous day's low. Great place to go short when resistance areas price breaks it and then comes right back down. Go short here at 74, or when the market actually broke the lows of the day right here at 92.50. Pretty decent trade. On a tick chart, you could have found probably a more precise entry, and that's why we use tick charts earlier today when this was kind of going up to the hourly right here. You can see it exploded up. Not a very high momentum on that way up. That means other dollar pairs aren't going up, other Swiss pairs aren't getting weak. Came down, went up again, and this is pretty much where I would have timed that. This would have been my first profit target, but it broke it, and it just kind of worked its way down. And somewhere between the first and second fib target, it's a pretty decent place to get out of your trade. So that was a nice 40 pip move there off of the hourly. And I rarely ever sell the lows, but when this thing kind of was hovering around here near the lows, not exploding up. If you want to take a shot at it, like I told someone in our class today, seeing a little narrow range pattern, getting short right here with your stop above it. And when it goes down and you're in a riskier trade like this, tighten your stop and don't be greedy. Draw your fibs off the first wave, and most of the time the fib target down there is going to be where you want to get out of the trade, especially if it's at or underneath the lower white containment band. So, pretty decent place to get out of that trade there. You would have been short around 30, out at 10 for a little 20 pip scalp. The pound also was strong today for a little bit, and then had a couple hours of pullback. There was an excellent trade I called out. Unfortunately, I didn't take it myself. Let's start earlier in the day. The weekly and monthly trend are up. So again, this hit the lower containment band without that much weakness, and it also probably was a fib target of this first wave down. You can see the fib target. Anytime a fib target gets hit, the market pulls back, pulls down again. It's a fib target near the lower band without that much weakness when the longer term trend's up. Pretty high probability place to get in if you're a longer term trader and looking to hold for a couple hours and looking for 30, 50, 100, sometimes 100 pip moves like this one. Again, with it right underneath the hourly right here, usually it's a pretty decent place to buy a breakout, but there's all kinds of resistance right above it. So the odds that this explodes through the resistance is pretty high. I mean, the odds of it against exploding through here, obviously it did in this case, but I wouldn't have taken that trade because of all that resistance there. But once resistance gets broken, pretty much tells you that there's nobody selling at levels where they normally do. And it's not the strongest one in the world, but you have a nice little pullback trade right here. The market went to the upper containment band. Great place again to get out of your trade. And we actually have a perfect Elliott two-wave pullback here that some of our traders in our live chat room traded and made some 20, 30 pip moves off of. You have the added benefit of other support areas. This resistance area, once broken, becomes support, and it's also an Elliott two-wave pullback. Notice the weakness, non-existent. Unfortunately, we didn't have off-the-chart strength on the way up, but usually when the trend's up and you get a two-wave pullback and the price especially is above the hourly, it's very high probability, probably 70-80% in my experience. A lot of traders bought around 80, 82 right here and rode it up to around 110 where it kind of ran out of steam. One of the trades I called out in the room, but I didn't take myself. Anytime you have a trend up right here, and obviously major support areas come into play, and the market comes back up, and it goes sideways for an hour or two, and plus it had resistance there before. If it breaks out right here, everybody who's sold here, here, and here, more than likely is going to have their stops right above the high. They're getting a little nervous. If you sold up here, obviously you made money on this move, but the market's not going down. So when it breaks out right here, it's very likely to go to the upper band, which is around 30. You're likely to make 20 pips, and you can see this one just exploded up above the upper containment band. Counter trend sell signal right here. You got 30 pips on that trade. I'm still kicking myself for not taking that trade myself. My biggest trade today was about 17 pips, selling the euro dollar way, way, way above the upper containment band, which is a risky trade that only recommend for experienced traders that really have good timing skills. But this was a very high probability trade, and it just worked its way up 30 pips in 15 minutes. Wonderful. And you can see that was pretty much the high of the move. Now the New Zealand, extremely weak. Sometimes currencies are down so much that it becomes risky to sell them, because they're just down so much. They've fallen 300, 400, 500 pips in a week or two, and there may be major support there. It doesn't really have that much room to go. So even though the currency is super weak and it has real-time weakness, you got to be really careful trading it. And if you are going to trade it, at least trade it against one of the ones that's the strongest of the day, which was the euro and the Swiss. So if you bought the euro New Zealand today, you probably would have made money, but I wouldn't have necessarily sold the New Zealand dollar. You can see this one, and again, it was up too much too. It was above the upper containment band. It really becomes risky buying at or above the upper containment band. So I probably would not have taken this chart trade. Let's look at the New Zealand Swiss. Weak New Zealand, strong Swiss. If it's not down too much, you can consider selling it, but again, it is. It's way underneath the lower containment band, and you can see it just kind of chopped its way down all day. There were no big moves, and most of the time this is what happens. So you would, just avoid frustrating trades that aren't likely to really give you much upside. You don't want to risk 10 pips if you're only going to make 5 or 10 pips. You want to risk 10 pips where there's possible opportunities where you can catch bigger moves, like last night. This went sideways for a couple hours, very similar to the pound dollar breakout to the upside I showed today. Anytime a currency goes sideways for a couple hours, the longer the better, and it breaks down. And you can see the daily, weekly, monthly trends extremely weak. You can see the real-time momentum earlier in the day was extremely weak. There was no strength whatsoever, and this just took off. This was the previous week's low is your profit target right here. So in this case, you're betting 5 to 12 pips, and you have a pretty high odds of making 35 pips. And in this case, the market exploded through that support area. It's way underneath the lower containment band. Our counter trend buy signals hit way underneath there, and you can see when the market's down or up too much, these counter trend moves oftentimes are the end of the move. So if you weren't out of this trade here when it double bottom right here and starting to go up, you're out of that trade down here at 64. But over a 50 pip move in about an hour or so, hour and a half, very high odds. This is a very good trade. Selling underneath the lower band, especially way down here, is very, very risky. It's a stupid thing to do, and it almost always loses money, so don't do it.